Economic collapse is not a new phenomenon, and there have been numerous examples of financial crises throughout history. These crises have been caused by a variety of factors, including excessive debt, economic imbalances, and financial bubbles. One of the most well-known examples of economic collapse is the Great Depression of the 1930s. This period of economic hardship was triggered by a stock market crash in 1929, which led to widespread bank failures and a sharp decline in economic activity. The Great Depression lasted for nearly a decade and had a profound impact on the global economy, leading to high levels of unemployment and social unrest. Another example of economic collapse is the financial crisis of 2008. This crisis was caused by a combination of factors, including excessive risk-taking by banks and financial institutions, a housing market bubble, and a lack of government regulation. The financial crisis of 2008 had far-reaching consequences, including widespread bank failures and a global recession that lasted for several years. While the causes of economic collapse can vary, there are several common factors that tend to contribute to these events. One of the primary factors is excessive debt. When borrowers are unable to repay their debts, it can lead to widespread defaults and financial instability. Another factor that can contribute to economic collapse is economic imbalances. When there are significant disparities in wealth or trade imbalances between countries, it can lead to social unrest and political instability, which can in turn have negative effects on the economy. Financial bubbles are another common factor that can contribute to economic collapse. When investors become overly optimistic about a particular asset, such as real estate or stocks, it can lead to an unsustainable increase in prices. When the bubble eventually bursts, it can lead to widespread financial losses and economic instability. Despite the numerous examples of economic collapse throughout history, there is no way to predict with certainty when or if another such event will occur. However, experts agree that there are steps that can be taken to reduce the risk of economic collapse. One of the most important steps is to address the root causes of economic instability, such as excessive debt and economic imbalances. Governments can also take steps to regulate financial markets and promote transparency and accountability in the financial sector. Individuals can also take steps to protect themselves from the potential impact of economic collapse. This might include diversifying investments, building up emergency savings, and developing skills that are likely to be in demand in a changing economy. While economic collapse is a complex and multifaceted issue, historical data suggests that there are several common factors that can contribute to these events. In theory, there are some strategies that investors may consider during a period of economic collapse. First, investors may consider investing in defensive stocks, which tend to perform well in times of economic uncertainty. These stocks are typically issued by companies that provide essential goods or services, such as utilities or healthcare providers, and are less likely to be impacted by a downturn in the economy. Another strategy is to look for opportunities to purchase assets that have become undervalued as a result of the economic collapse. This might include real estate, commodities, or stocks that have taken a significant hit due to the downturn in the economy. However, it is important to do thorough research and analysis to ensure that the investment is sound and has the potential to provide long-term returns. Investors may also consider diversifying their investments across multiple asset classes to minimize the risk of exposure to any one asset or sector. This might include holding a mix of stocks, bonds, and cash, as well as assets in different geographic regions or industries. Finally, investors may consider taking a contrarian approach to investing during a period of economic collapse. This means looking for opportunities where others see only risk, and being willing to invest when others are selling. This approach can require a high degree of confidence and patience, but can also lead to substantial returns if successful. It is important to keep in mind, however, that investing during a period of economic collapse can be risky and unpredictable. It is always wise to seek the advice of a qualified financial advisor and to carefully consider the potential risks and rewards of any investment opportunity.